As we showed you, oil taking a bit of a wallop today. The price for a barrel of crude dropping around 2%. My first guest expected a sell-off, just not this much. For more on this, we're off to Chicago to speak with the co-founder and chief market strategist of Path Trading Partners, Bob Iaccino. Good to see you, Bob.
Good to be here, Greg.
All right, so we still have oil above $50 a barrel, but we have taken some steps back. What's going on?
I think it's a couple of things. You saw, again, near record longs coming into the commodity markets in crude oil specifically. Same way we see the piling up of the shorts in natural gas now. And when that happens, you tend to see an extension lower when they decide to get out. I had a target of 52.43. We hit 52.86 or so. And this was a price target, not necessarily a resistance level, but a target where I thought crude would get to in the short term. And now I'm looking at $58 to $60, but not before a pullback. When you led into me, I said that I was expecting a sell-off, but not this much. It's more not this much, not this quick. What really happened is we now broke out above. Everyone talks about psychological levels. They exist. To me, they exist every $5 to $10, not every 50 cents, like a lot of people say. But the $50 level psychological and the actual price action technical level is $50.02 where we broke out. So a pullback with today's low in WTI of 50.07 is a buy for me, and we did see some buyers come in there. We still got a lot coming out this week. We got EIA, we got API. We're going to have another rig count issue. We saw an uptick on rig counts on Friday, one well. So now we got 5 out of the last 7 weeks. We see rig counts lower or flat or up 1. Now, granted, the shale production came in higher, OPEC production came in higher, but I think the trajectory, capital spending-wise, rig counts, is still for lower production out of the U.S., or rather lower production growth.
Now, even though we've managed to get oil back above $50, the energy space in terms of the companies remain pretty unloved. We're now kicking off today, the last quarter of the year. Any chance that some of these energy stocks could show us something? We could probably use it on this side of the border.
Yeah, I think we've got a pretty mixed bag in terms of the energy sector. What I mean by that is I do believe prices are going to crawl up in toward the first quarter of next year, again, reaching that 60 level. I think a lot of it's going to be on an extension of the production cut. Russia's oil minister, at the last meeting in Abu Dhabi said it doesn't make sense to discuss extending the cut until January. That's exactly what I think they're going to do. I think part of the reason they said that is because prices were pretty much where they thought they might be after failing in the first couple of quarters of the cut. So back to the story about the energy sector. If we have higher prices, that's good. But if they can't put forth CapEx in a free-flowing way like they did before, it's going to be higher prices on what I consider to be slower growth, or rather a slower growth of that production curve. And that's what I think is going to happen. So I think the energy sector is going to be okay, but I don't think it's going to rocket back and catch up to the S&P. I think prices are going to go higher, but the companies are still going to be reluctant to put that CapEx forward, especially when you look at the crude oil curve not being in contango any further out than March 2018, so that hedge option is gone, and that's going to sort of mute CapEx as well.
Now, Bob, when we talk about the overall market, there's been an incredible lack of volatility. Heading into September, a lot of the big brains are saying, watch out for September. Hold on to your hats. Here it's going to come. We've pretty much gone through September unscathed. Did we escape it, or did we simply kick the can further down the road?
This is a matter of people saying we're due for rain. Well, they're eventually going to be right? We're due for rain, but you can have a 10-year drought and you can still say we're due for rain. We're due for a sustained volatility spike, but I still think we're just going to get short-term jumps, and here's why. I think volatility globally is down. It's not just the VIX. Right? You've got emerging market volatility pushed to record lows. You've got bond volatility pushed to record lows. Inflation expectation volatility at record lows. It's across the board globally, and I think it's because of an over-communicative Fed and a central bank globally, the central banks globally being overly communicative. And what I mean by that is they're telling the market what they're going to do, and then they do it. That's great if the data continues to back that up. But I think they're going to end up somewhere down the road in a situation where they're telling the market they're going to do something, the data's not going to support it, and then they're either going to do it into bad data or they're not going to do it, both of which are going to be surprises to the market. That's the volatility we used to get, surprises to the market, especially in interest rate policy. It's coming, but in a different form. It's not going to be here in December, though.
Right now, we do have the hawkishness from the Fed that they don't seem to be diverging from their path. This obviously has consequences for the U.S. dollar. What are you starting to think in terms of positioning yourself if we keep seeing strength in the greenback?
I think I want to sell the greenback, just not quite yet. We got another start to a potential fourth week up for the dollar in terms of the dollar index. The euro's helping quite a bit by having a region of Spain vote for independence. They had great PMI, but everybody's looking at the Spanish vote, the Catalonian vote, as being more populism, and we thought populism was dead when Emmanuel Macron won. And then we saw with Angela Merkel losing her majority that maybe it's not dead. And with the what some would consider the alt-right party in Germany getting a seat at the Bundestag for the first time since 1939. So perhaps populism isn't dead, although the euro economy still looks strong. I'm sure Mario Draghi's happy to see this. We're going to see this week how concerned the ECB was about the currency. But for Mario Draghi to actually say another 5% higher would concern them, I bet it was a pretty big point of conversation in the ECB meeting. We're going to see that this week. So once all that settles in and everybody realizes you should be buying the euro again, which may not be right here, I think the dollar weakness is going to turn around. I don't think Janet Yellen's going to be able to jawbone the dollar higher by talking about rates. I think the balance sheet normalization is appropriate. I think a continued schedule of rate hikes is not.
Now, one thing that had us very concerned only a couple of weeks ago, and we seem to have forgotten about completely, North Korea. Should we be concerned going forward, or was this simply political theater that we can hopefully safely put behind us?
Talked about it last week with Michael. This was WWE stuff. It's just two guys yelling at each other in front of a camera, saying on October 15th, this will happen, and then nothing ever happens. I think that's going to continue for a while. I don't think North Korea is going away. They're not giving up their nuclear program anytime soon, and I don't think there's a whole lot we can do about it. Although you did see out of China, I haven't seen official declarations, but I've heard anecdotal stories about them telling North Koreans to shut their business down and get out of the country. We'll see if that has some sort of effect. It might have already had an effect on rhetoric, but again, until there's some sort of an official declaration that China is actually taking that drastic step, I don't want to go too far with it. But I don't think it's going away, but you're seeing in gold in the VIX that it doesn't matter as much as actual actions would.
Thanks, Bob. Always a pleasure catching up with you.
Good to be here, Greg.
That was Bob Iaccino, co-founder and chief market strategist at Path Trading Partners in Chicago.